Let's go.
Well, good morning, crypto Twitter and others that have found themselves to this channel today. We've got Tillman, Dave, and Josh, and we're following up here on a day after a day that saw Bitcoin pop in a serious way, as well as other assets. So we're here to talk about it. Is this rally sustainable? Where is it coming from and where is it going? That will be the nature of the conversation today. So happy to have you here. Wanted to start with Dave because he's the guy with all the charts behind his head. So he must know where we're headed. So Dave, hit it, my man.
I mean, what was interesting about yesterday is the biggest part of the rally happened right as futures were closing, which always makes me skeptical. You had what was atypical for the most recent past day of very low volatility, grinding kind of higher without a whole lot of oomph behind it. And then the futures closed, probably there was an order that was running and they just ran out of selling liquidity on the other side. The candles were not huge. It was not like massive market orders buying. But what we've been seeing is something that is just important to understand about how markets work. Is there are consistent buyers in Bitcoin. We kind of know where they're coming from, institutions in the sense of corporations and large funds that are using things such as the software behind us, which is CoinRoutes. And anyone who cares, you can go to coinroutes.com and check it out. But, effectively algorithms, which are disciplined, slow algorithms that are buying irrespective of signal, which is distinguished from Arch because Arch is essentially, effectively deciding when to buy and when to sell. CoinRoutes is told buy it over a period of hours, period of days, and it will continually and dutifully do so. When that's happening in a normal market, you don't necessarily know that it's happening. When it happens and sellers stop selling, the market goes higher in a grinding way. And when the sellers overwhelm them, the market drops. And we've been seeing this for months now. And I'm really curious what Josh is seeing because his clients are the ones who are playing this game and trying to trade around it. But the most important fact, and we talked about it on Macro Monday yesterday, is that Bitcoin's volatility is now lower over the last few months than the S&P. Anyone who's watched Macro Monday for any length of time or Market Mavericks, which is the other show that he does with Scott, sees Mike McGlone constantly making this chirping of that, well, Bitcoin is a high volatility asset that trades at 3 times the S&P. Well, guess what? That was true, but it certainly isn't true right now. Bitcoin is trading with lower volatility. And historically, whenever Bitcoin's volatility is compressed like this, it's been right before a big move to the upside. Does that mean it's going to happen this time? Of course not. Does it add to my thought that will probably happen? Sure, it does. But, markets rarely do what we expect. All I can say is even right now, if you look at the chart right now, the intraday, the 1-minute candles are tiny. I mean, Bitcoin has been, let's see what, I'm trying to get this right. So for the last hour, Bitcoin is traded in a range of less than $242 for the last hour and a half, as we go into the open. I mean, $200, just for those who understand, can do math. That's less than, it's basically 20 basis points, 0.2% for an hour during the, quote, price discovery time of Bitcoin. That is ridiculously low. So you have a market that's balanced. And so, guys, that's the way I'm looking at it. And a balanced market tends to move violently when the balance is broken. And who knows which direction the balance will be broken in.
Well, Josh, I believe they call that institutional adoption, right? Once we get to this level of institutions trading Bitcoin, owning Bitcoin, the BlackRocks of the world, the movements tend to tighten just a bit. And they tighten inside of generally market hours, 9:30 to 4 p.m. Things tighten up a bit. Here's what I find compelling, right? whatever the machinations of the move yesterday, we are where we are, and we haven't given it back in a meaningful way. At the same time, Circle goes public and goes up 300 or whatever percent. So I find it interesting that there's lots and lots of capital available for both increased inflows into Bitcoin as well as inflows into a quote unquote crypto IPO, across the institutional space. What have you been seeing?
Yeah, I mean, I think that's fair. I mean, look, to your point earlier, yeah, look, as assets become more liquid, they generally become less volatile, right? And Bitcoin is incredibly liquid, so you're not going to see, I think Axelar pumped 70% this morning. You're not going to see that in an asset like Bitcoin, just given the liquidity that it has now. And yeah, I mean, I think Circle's IPO has definitely brought a lot of euphoria to the market. I mean, it's trading at some insane multiples, which right. I mean, I think if I'm Jeremy Allaire and I'm within my window in which I can sell Circle equity, I'm probably hitting the sell button as fast as I possibly can at this point, and as much as I possibly can. And I imagine that goes for a lot of shareholders in Circle, because I mean, you guys probably have seen some of the numbers that have been shared on Twitter. I don't know them off the top of my head, but just looking at the difference in what Circle is trading at as a multiple of its USDC revenue versus what Coinbase is trading at as a multiple of its USDC revenue, which is the same amount, is completely insane. In terms of, the altcoin market and why it's moving, I mean, you also have to remember the altcoin market has just been bleeding. And I think people are desperately looking for things to latch onto. I mean, I'm just looking at, like 365-day returns, 180-day returns. I mean, on the last 180 days for anything not named, I'm looking at the top 25 by market cap, everything is down 20%, 30%, 50%, unless it's named Hyperliquid or Bitcoin or actually Tron, sometimes defies markets as well. But as I think caught on a little bit to the stablecoin narrative too. So, yeah, I mean, I don't know. I mean, I think this is a bit of a bounce. It's just, I'm not aggressively on the narrative of the altcoins are totally rallying, because I'm not convinced that there's a ton of new money funneling into the altcoin space at this point.
Well, in the altcoin space, to be fair, the capital that's going to find itself into the crypto space, via traditional markets, the IPO markets, that's going to happen at the exchange level, the stablecoin level. There aren't any altcoins set to go public.
But there are like these new, public treasury companies that are being set up to buy some of the alts. So that's starting a little bit, and that's going to create some bid, as we've seen, as well as ETFs starting to get approved around alts. I think there's going to be a lot of, I think there's a lot of excitement around staking ETFs getting approved, and potentially increasing demand, as well as, more, I would say smaller cap alt ETFs and multi-asset alt ETFs. So I think there will be a public market play here, but I think certainly you'd like to see money funneling into the crypto space. And I think that might start to happen. I mean, I think it also, if you have crypto, I think the way that it comes into the market is actually different than how a lot of people are thinking about it. There are a lot of crypto funds that do both equity investments and token investments. If a crypto fund had Circle in it, all of a sudden their DPI to their investors is going to look materially higher, and they're going to have better returns, and they might be able to raise more capital. And so I think, funds that are both equity and token funds might actually see some decent performance here, and could potentially, attract some institutional inflows. And if we get more capital into liquid funds that are buying tokens, I think that's broadly beneficial. I mean, most funds in crypto are what I would describe as like crossover funds in equity markets, right? That are trading both liquid and, equity positions. And so, yeah, I mean, I think it's going to have some knock-on effect, right? And if people are excited about crypto broadly, family office might be like, how do I get involved? How do I play? And so, I'm hopeful that creates some knock-on effect, but I don't think you're going to see that immediately.
Tillman, what do you think the second half of, because we're just starting the second half of 2025, what is the narrative, the overall narrative, do you think is going to dominate? Is it going to be Bitcoin balance sheet, Bitcoin Treasury, or will it be, the launch of, ETFs associated with XRP and Solana and others? associated with altcoins. What do you think is going to dominate headlines?
I think, just as an overarching kind of theme, people prefer more volatility than not these days in whatever they're trading. I think trying to pick where the God candle is going to happen for Bitcoin's a futile exercise. I don't try to do that anymore. I look at that as my long-term HODL bag, and it's a savings account, right? You're just putting it away with almost a guarantee that it's not going to inflate and lose its purchasing power out from underneath you over time. And then, if you look at if that's compartmentalized, and then you look at the volatility that Bitcoin presents, Wall Street loves predictability, loves it. And if you combine predictability with volatility, you get a lot of opportunity. And so you look at this stupid headline between Trump and Musk, it produced 10% move, 5 down, 5 up on a highly liquid, instantly settled asset that you really don't care if you don't have the upside immediately, because you're trying to accumulate for the long term anyways. And so if you know how to play the volatility, then you know that it looks to me like Wall Street is setting up all types of vehicles that work off of the base asset of Bitcoin. And, to Josh's point, the equity piece of this and the amount of debt capital that you can raise with Bitcoin on your balance sheet versus without it on your balance sheet is a material game changer. It changes your entire existence and your identity to the world, and takes you from the small stage or the crowded stage where you're not getting any of the spotlight attention to being like one of the few people that get a lot of stage time in this world. And that's exceptionally valuable when you're really selling nothing more than holding Bitcoin on your balance sheet, right? First to market mover advantage is like where everything is. So I think there's going to be some underlying currents that really move the markets. I think banking and the adoption of Bitcoin in the banking system is a massive, massive theme. But I do think the overarching theme is the yield potential of the volatility of Bitcoin, and major players looking at, okay, how if I want to own more of this long term, and I believe it's going to what Larry Fink says it's going to, and it's something I need to diversify into, well, then I'm going to play the volatility to my advantage. And when you're sitting on a lot of cash, you're never forced to sell. And by definition, those people are all sitting on a lot of cash. That's why they're trying to diversify into Bitcoin. So it's a different driver this go around than we've ever seen in the markets before. I've said this before on a lot of podcasts, but the first cycle I was ever a part of, the miners drove the price. If the miners were selling, the price went down. If the miners were holding, the price went up. It was really that simple. And then the next cycle, it was like the ICO type craze, where it was whichever exchange offered the hottest token, that was where all the volume shifted to. And that's really what drove the markets and the pumps. This is all Wall Street, I think, this go around. It feels completely different to me. The volatility is tightening, but it's tightening in an upward trend, which is the predictability plus the volatility that yields opportunity. So that's the way I kind of look at it. And everyone who knows how to play that game, they're exceptionally excited about Bitcoin. There is no news that you can tell them that makes them sell, like the Elon Trump fight. That's just a buying opportunity for those people. They don't see that as oh crap, this is going to change, my investment strategy as it pertains to diversifying out of the dollar. So I think, that's where the retail is getting flushed out. And as long as there's retail to get flushed out, which there is, a lot of volume, lots of leverage getting, absolutely decimated during these shakeouts. Why wouldn't they do it? It's how they make money and accumulate a stack.
BlackRock exec said yesterday, and I think it's important to try and push ourselves outside of the crypto bubble. But his point is financial advisors, wealth management folks across the country and across the globe are just now beginning to dip their toe into the Bitcoin and overall crypto space, because it's now becoming generally accepted and available. And we're talking about very, very small amounts, and then those amounts continuing to grow over time. Nobody has a better pulse on that than BlackRock, obviously, with their most successful ETF in the history of their company, IBIT. So, where do we head in terms of volumes? Where do we head? Is that effectively a bid underneath the price of Bitcoin for a while? And what does that mean? We watch, whether it's Tom Lee or others on different shows, and it's short term 250 to 300K, long term 3 million. Just talk about the dynamics of what that looks like, short and long term associated with Bitcoin price, and how are different organizations, especially on the institutional side, Josh, how are they positioning? How are they playing both short-term movements and then long-term, what I would just call philosophical commitments to Bitcoin as an asset?
Yeah, I mean, I would just comment here that when we talk about BlackRock buying, it's not BlackRock buying. It's
of course, it's their customers. Of course, we all know that.
And from talking to a lot of the ETF issuers, more than half of that is still retail, right? So even though it's BlackRock being bought, it's still retail on their brokerage account buying the BlackRock product. And when you talk about financial advisors offering Bitcoin, that's it's retail people that end up buying Bitcoin. And so there still is a lot of retail that's behind this. It's just retail, being able to access these products more accessibly, or maybe having people that they trust and brands that they trust putting their name behind these products as well. Yes, there is certainly 100% institutional bid, 100%. That's a huge part of what's driving this. But there's also a lot of forced buying activity through a lot of these, treasury strategies as well. That's bidding up price. I would, it's impossible to know, but I would guess that more of the movement is happening because of all these treasury companies bids than because of Bitcoin, because like Michael Saylor will top blast Bitcoin. I mean, he talks about it. He's more than happy to top blast Bitcoin. Not always. I see Dave hates what I just said. But are you on mute, Dave? I can't hear you.
Yeah, he is on mute.
Yeah, I'll comment on that in a second, but finish, please.
Yeah. No, look, I mean, I think that's part of it. But to the point, and also institutional buying is not always buying. Sometimes it's doing a basis trade or something else to take advantage of movement in the market. But I do think there is, because of the ability of financial advisors to offer Bitcoin, because of, now, Bitcoin is part of this dialogue of, hey, should you have a 0.5%, a 1%, a 2% exposure to Bitcoin? I have the majority of my liquid assets in Bitcoin. So I'm a huge believer in the narrative and I'm behind it. So yeah, I get it, but it's more than just institutional. There's certainly still retail bidding here as well.
Yeah, I mean, I want to make two comments. Well, actually, probably there's a bunch of stuff to talk about.
You always want to make at least two.
The word top. I hate the word top blast, because that's not what he does. Actually, I think we're on 5 straight weeks of buying from Saylor where his published price was below the price on the day.
I think I said he's not afraid to top blast.
Right. Well, yes. But the point is I think you and I both know that you're going to agree with what I'm saying. It's just a question of words. There are a lot of people out there that believe that Saylor buys OTC and just buys the top and pushes the price up. And the reality is Saylor's using algorithms, via, in most likelihood, is it used to be Coinbase. I suspect it still is Coinbase. And Coinbase has an algorithmic platform that's very similar to CoinRoutes. And so I understand it pretty well, as they bought one of our competitors 6 years ago. And that allows Saylor to, stretch his buyout over a short period of time, probably a day or two in the middle of the week, and then he announces it on the weekend. And that's why in an uptrend, he tends to look like he's buying it. What he's totally not afraid to do is to put capital to work, because he believes Bitcoin is north of a 90% discount to where it should be. And therefore, the more he can get to work sooner, the more money his shareholders, and he, by the way, being the largest shareholder, will make. And so that's his philosophy. But this notion of Bitcoin treasury companies really boils down into 2 things. Thing number one, and we've seen this before, is a copycat. okay, I have cash that I might have otherwise put into treasuries to, or I might have used to buy back my own stock. But if instead of doing that, I buy Bitcoin, I can pump my stock more than by buying my own stock. And a lot of companies are starting to realize that. Keep in mind, and this is the data, Saylor's first conference where he had CFOs who were interested, who were Bitcoin curious, was 2,400 CFOs. There are well less than 200 of those, i.e. less than 10%, have put money into Bitcoin at this point. And there are quite a few other CFOs of other public companies around the world who have done absolutely nothing. And this is a copycat world. I saw it viscerally in front of my eyes 20 some odd years ago when every single company was putting out a press release about how they had a website. Why? Because if you said you had a website, your stock went up. Companies are going to put cash into Bitcoin. It is inevitable because they're going to see it as a better way to manage treasury and also at the same time goose their stock price. And until it stops working, they're going to do it, which means this is not even close to the end game yet. Yet all the people in the crypto world, not all, but a lot, look at this and say, oh my God, when they introduce futures, that was the top signal. Oh my God, when we get a lot of leverage, the market drops. And that one is true, except for the general part of leverage, the thing that you really care about, which are the funding rates on the perpetual exchanges that in previous tops traded 5 times the volume of spot, are very, very low. So there's not a lot of hype out there. And so if you ask yourself about price drivers, it's like corporate America and corporate world, people will be buying Bitcoin because it makes sense as they have earnings. Now, if we go into a recession, they'll have less earnings. They'll need to sell because that's cash that they might need. If the economy stays okay, it will continue to go up. And so this is an important factor. As far as retail is concerned, yeah, absolutely. People are starting to buy. They're dipping their pinky toe into the water. But go out and have conversations with normal people. I've had a lot of people asking me about it, and I'm pretty sure none of them have done anything about it. And I've given them advice, right? I mean, and that's a big part of it because retail tends to get in when you see lots of Google searches, lots of hype, lots of volatility, not when it's calm.
Tillman, the balance sheet conversation is not just a narrative, right? There's actual math behind it. Talk about that math and what it does.
Yeah.
To revenue, earning, all of those things.
I think there's always the sizzle and then there's the steak. I think the sizzle is the public, highly leveraged, debt financed Bitcoin treasury companies. I think those are the sexiest things to talk about because they have the largest MNAV. I don't think that that's really what the substance of this movement is about. I think the substance of the movement's about real companies that are private and small putting Bitcoin on their balance sheet because they're the ones that need it the most. And they're cash flow positive. They're not zombie companies that have been resurrected from the dead just for the purpose of holding Bitcoin. Yeah, you can raise money on debt. Fantastic. Yes, you've created a vehicle that allows more people to own Bitcoin based upon their charter laws and rules. All of those things great for adoption, all those things great for the depth of liquidity of the markets. But the real narrative, and I know this because I'm working with a lot of customers, and that's what Arch Public does, is help you set up your own personal treasury strategy and have it execute for you, and help you set up a corporate treasury strategy. And you would not believe the amount of money that is out there wanting to fund private deals that are cash flow positive that want to have a Bitcoin treasury component to it because they understand here's a perfect example of what the difference is. What if you had done that through Dillard's heyday? What would Dillard's company structure look like right now? They would be so flush, they'd be high on the horse. They'd have so many Bitcoin if they had dedicated 20%, 10% of net profits into a Bitcoin treasury strategy, a savings account essentially. And if you do the math, you can see that like one of our customers, their company across all of their locations does about 25.7% in net profits. Well, when you deploy 10% of those net profits into Bitcoin, it doubles their.
He went
Opportunity to.
You had the money line and you went silent for a
Yeah,
second.
you got so excited, and then all of a
Yeah.
sudden the audio.
No, honestly, that was my mom calling me. Honestly, so she's checking in on me this morning, making sure I'm doing all right.
Stop spending that damn Bitcoins.
No, but I think that what's going to really drive this is people recognizing it for its true utility. And I think that's what this whole cycle is going to be about, is what is the utility of the crypto that you're participating in. And I think we've all voted, everyone in TradFi and crypto sanity world, that the best utility for Bitcoin is a store of value, a hedge against inflation, an indication of global inflation, however you want to characterize it. It is the best measurement tool we have ever designed to tell us really how many dollars are being inflated into the global economy. That is what its usefulness is. And when you put your money towards that and it's got a limited scarce supply, price go up. That's just as simple as it gets. So I think utility is going to be what drives this market. I think you're seeing that on the Bitcoin front. I think private companies are going to adopt it as a strategy because there's a lot of utility behind it. If you're a construction company and you're having to go out and get construction bonds for your projects and you're paying 1-2% per job to get those contracts bonded, you could self-bond if you just put 10% of your net profits into Bitcoin for long enough, and then you just pledge that collateral against the risk, and you're self-bonding your projects, and you put in a very competitive market with very small margins and a lot of risk and a lot of cost to carry. You've created a competitive advantage for yourself that allows you to grow quicker than the guy down the street. And that's a huge deal. That's going to drive, more VC dollars into those models, expand the territory that they cover, the market share that they have in every sector and category on the face of the earth. And one more thing before I will say, the Michael Saylor thing is very, I think, misunderstood. He does tease about I'm smash buying the tops and stuff, but what he's really doing is taking advantage of the line of credit when it's the highest. The price of Bitcoin, when it's the highest, makes the price of his shares the highest. He's borrowing money against the price of the shares, so he's getting the most leverage when the price of Bitcoin's the highest. It's a self-fulfilling prophecy. It's no different than him just going to the bank when the bank's offering him more money. And so that's why he's buying the tops, is because he's getting a better multiplier in terms of the cash that he can borrow against that purchase. And, if it deviates a little bit from the tops, as long as he's essentially securing the capital at the place where he can secure the most, or get the most out of it, then that's really what he cares about. That's the way I see it, at least. So those are my 2 cents.
Can I make a point about, just to back up something you just said, because I think it's critical. So you use the word utility. I don't know if any of you guys watched yesterday. I did the roundtable that the SEC Crypto Task Force had. But there were a bunch of really interesting nuggets in there. I think that the most interesting, though, came from SEC Chair Paul Atkins, who effectively gave his wholehearted blessing to the fact that it should be a fundamental right to effectively, self-custody.
Mm-hmm. Yep.
Now, this is a huge deal because the SEC for quite a while, through multiple administrations, and Caitlin Long documented this really well yesterday, has been on the warpath against bearer assets because it decreases control, etc. But if somebody could use a platform like Arch, for example, buy on Gemini or other exchanges, take that Bitcoin, put it into their own wallet, be able to handle it in their own finance and be self-sovereign, that is true utility for that person. And in fact, the chair of the SEC, which is really a mouthpiece for the administration at this point. I mean, Brian Kintens hasn't been confirmed at the CFTC, but I guarantee you he says this will say similar things. He's been an advisor to multiple crypto companies after working at the CFTC. What that means is the regulatory apparatus of the United States is behind the utility of Bitcoin. Mm-hmm. This is a non-trivial thing. Now, do I think that's what caused the rally yesterday? No. Could it have caused a rally if people were paying attention? Sure. The other big thing that's happening is the stablecoin bill and talks about the market structure bill. Now, people, the policy wonks talk about this a lot, but it's a very big deal, because what the stablecoin bill will do is it will revolutionize the payment system globally, certainly starting in the United States, and going from 3 days to move money to 3 seconds. And that matters. That means that money, which used to be trapped, and there's about 6 trillion that's trapped in accounts that don't pay very much interest. And we kind of blithely toss out, oh, 6 trillion is trapped. 6 trillion is trapped. And so that money is going to go to yield bearing or appreciation style savings vehicles. So if even a small percentage of people believe that, hey, this idea of saving in Bitcoin and spending in dollars is a good way to live my life, companies will come up with products to do it. And because the stablecoins will be able to implement it, because those, of course, will be on tokenized, and so therefore it'll all be using stable rails. So it's a very big deal. You're going to be hearing about this a lot more in the back half of the summer, but keep in mind that these are the key gating factors. So once we get a stablecoin bill, once you have this stuff go through, then all of a sudden, a lot of what we know is technically possible will start getting developed by companies.
Does this, a question that I have, and part of the question is, are we not talking about this enough, right? Is this the kind of thing that, is Circle the kind of thing that we're not talking about enough? A week in, not even a week into its life cycle as a public company, and is the adoption, let's call it, the hoovering up of the share price to push it to where it is, does that make a material difference in the stablecoin bill getting done? Absolutely getting done, as opposed to there's still a little bit of a question about it. What do you guys think about that?
I mean, I think the answer is predictable, to use your words, somewhat sad, but pretty inevitable. And that is, I just actually posted to somebody, I think it was Clint Donnelly, posted something about hearing about how the Democrats are rallying behind the stablecoin bill, not even understanding what it is. And their reason is because of campaign funding from the crypto industry. The more, if it becomes incredibly obvious to anybody who's not living under a rock that there is a public appetite for people involved in crypto for their equity, what does that mean? Well, that means more money moving into politics, and that those politicians, that's really what they care about. And so the answer to your question becomes yes. May not be for the reason that I want it to be yes, but the answer is, I think, yes.
Yeah, again, the amount of capital, to me, the narrative for the rest of the year is the amount of capital that's going to continue to move into the space, for principally 2 reasons. Companies in the space going public, and they have effectively new currency to throw around like crazy. Go look at what Coinbase did in their first 18 months after they went public, and the amount of companies they gobbled up. And then secondarily, again, this stablecoin bill is going to make a material difference in the way that money is moved, ergo the way that markets react to the way that money is moved. If you're able to move money, as Dave just said, in 3 seconds, there's got to be structural changes to the way that markets react to it. You're seeing that with NASDAQ filings to go to 24/5. Robinhood is doing the same. We're going to go to probably 24/5 across everything. And then it just becomes a question of, at what point do we get to 24/7? So, change, oftentimes there's a decade of change that can happen in a few months. And I think we're to some degree on the precipice of that. I think that's absolutely the case. Over the next 6 to 12 months, we'll see the structure of markets rapidly change. And, there is something to be said that crypto has effectively pushed innovation in that direction, and nudged and nudged and nudged and pushed and pushed and pushed until we find ourselves in that position. What are the opportunities? The question is, what are the opportunities associated with a 24/5? What are the opportunities with a 24/7? What are the opportunities associated with the adjustments and changes to how money moves? That's the question. And, you know, put it to the panel. Where are the opportunities? Where do the opportunities come from when there are structural changes?
I think the structural changes are great. I do think it adds volatility to the mix because you have less liquid time frames to take advantage of, which pushes price. I don't think that's the real thing that has caused me pause this cycle as it pertains to specifically stable coins. Stable coins, I've always had a problem with them. Here's the problem: counterparty risk, execution risk. I love if they're denominated in T-bills because it strengthens the US dollar. I think we all as Americans have to agree that we want to keep the US dollar as strong as possible globally. And so how do we use this technology to support that narrative? Because that's the narrative that we go to war over. That is the strongest narrative. It's the one that we've defended this, you know, with the most might. And that's why we've been as successful in creating opportunity through entrepreneurism and innovation as we have, because that's what drives our markets. And so I think that when you're looking at stable coins, what Caitlin Long did about a couple of months ago on that podcast with us, when she announced the first deposit token transfer between banks internationally, she kind of blew my mind, and I still haven't figured out how to get out of the tailspin. Because here's my logic behind this: stable coins, if they're denominated in T-bills, great. Use them on exchanges for instant settlement, for 24/7 functionality, all those great things. You know, the new stock market that they're opening up in Texas, let it run on stable coins. Fine, great, as long as they're denominated in T-bills. But where the delineation and the real interesting piece comes in for me is how the banking system is going to transfer the money, because they've got the technology right now to take money in your bank account and create a digital cashier's check, send that to another bank that's instantly settled into another participant's bank account. Why is that such a big deal? Well, because if you fat finger a stablecoin transfer, you're screwed. If the bank fat fingers a deposit token transfer, they go to the courts and print new money, and they get your deposit back.
Yeah, but so, I think that's, I mean, the courts have ordered Circle and Tether to freeze a ton of assets. I don't think that's a problem at this point. I mean, you see court-ordered freezes of stablecoins all the time. Yeah.
Well, it's interesting,
especially with regulation, right? Especially with you know, U.S. regulated stablecoin issuers. I don't think that's gonna be a problem at all. It's incredibly, I mean, you see it whenever, you know, North Korea, the Lazarus Group hacks a ton of stables. They immediately try to get them out of stables because they know that they're going to be frozen the second that they find out, right? And
well, I think you're right on some fronts, but I know a lot of folks, and I've read a lot of articles where the courts haven't ruled in their favor. And so I think, to your point, I think the courts are going to have to decide what precedence is here, and they're going to have to have
different. I mean, you explained a Chase transfer to Wells Fargo. I think if Chase goes to the court about a transfer, that's different than an individual going to the court about a transfer, right? Just the amount of power a large U.S. bank is going to have, especially once stablecoins become regulated.
I would agree with that. I think we need to see the courts, though, from a retail perspective. If we're all allowed to use stable coins, why would I want to use them individually if I don't have any protection?
Yeah, no, I don't know. I can't comment on that, but I'm just
what matters about stable coins, and there's a lot of things that matters, but what matters about stable coins is the actual technology to transfer money from bank to bank, from be able to pay your bills, is about to get dramatically faster and cheaper. And so we have all this stuff wrapped around an archaic system. There is a reason why credit card companies get 3%, and it's not just because of air miles, and it's not just because there are a bunch of things that people will still do. Look, people will still use credit cards. You know why? Because you want deposit. You want to know that if you buy something and it breaks or they screw you, that the credit card company can withhold payment and get the money back and claw the back. So it's not like they're going to go away. But underneath the credit cards, the payment mechanisms are going to be stablecoins. Why? Because it's dramatically faster, cheaper, more efficient. And so when you make things dramatically faster, cheaper, more efficient, it allows It takes friction out of the process. The most important thing with stablecoins, I will continue to tell people, is the frictional cost of moving money is going to decrease. We have this idea, there are all these ideas in the banking system that are that we needed, that were adaptations to inefficiency, things like overdraft protections and overdraft accounts, and of course overdraft fees for when the bank decides to cover for you and you pay for that. Well, these things don't become necessary if the bank has access to your accounts, but right now we've structured it in a way that they're separate. Hell, fractional reserve banking as in totality exists because capital used to be really localized, and you couldn't get capital in a certain, if you were in Jimmy Stewart's village, whatever the name of that town was, and It's a Wonderful Life, you needed the savings and loan because there was no way to get capital any other way. Well, with the internet and the rise of mobile capital, you could make a very strong argument that's no longer necessary. The point here is that crypto is revolutionizing the financial system. It's what we've been talking about in some of our cases, in my case, for 8 years. It's now starting to be seen. This is simply one of the first places with product market fit inside the financial system. There will be many, many others. This thing, they were talking about DeFi yesterday. The problem with DeFi isn't that it's not a good idea. I mean, things like Aave, they pointed out, succeeded, whereas all the centralized lenders failed, or the vast majority of them did, because it was code. And sure, that's true. That's absolutely true, actually. But I view it as more of a proof of concept. When you have DeFi underneath the trillions in the securitization market, then it will be something. But those are all future things. It's just important to understand where the building blocks are. And so if you're looking at a strategy, it makes sense.
I think the question that everyone listening wants to know, though, isn't are stablecoins exciting, which I think everyone at this point completely agrees on. It's, Dave, I'm looking at your screen. You probably got Bitcoin at the top, but there's a lot of things under that. I think the question people have is, what does it mean for everything under Bitcoin on your screen over there?
Right. And that's a great question. So, there are, for example, let's pick the two that I don't remember whether it was Tillman or Andrew mentioned. So two of the coins that are on there are XRP and Solana. Mm-hmm. XRP and Solana and a bunch of others are vying to be the base layer to support new transaction modalities. Now, boy, does that sound geeky. But the fact is that the way exchanges work and the way money moves when it is right now, everything is centralized exchanges. Everything is done via proprietary systems. Both XRP more in payments and Solana more in trading are vying to be part of a newer globalized infrastructure. If those things take form, so if Solana broadens beyond memes to trading of everything, then it's going to be worth a shit ton more than it is today. The total addressable market for providing that as a base layer is significant. The same thing with XRP with regard to payments and SWIFT. And if XRP underlies the stable coins that are become, if basically not just RLUSD, but if Chase Coin and JP Morgan Coin all use the XRP ledger, then it will have value. If it doesn't, it won't. And so it really becomes a question of that word that I think it was Andrew that used, which is utility. If they have utility, they will be worth more. Elsewise on the screen, and of course you could mention Ether in the same thing in terms of tokenization. And so, that's a big deal. I mean, I'm watching very interesting to see how Kraken does with their pilot for having U.S. equities trade outside the United States 24/7. Yeah. I suspect it will do better than some people think. And if it does, that's going to be a pretty important proof of concept. But there are many other things going on in crypto. There is gaming, there is DePIN, there is DeFi in terms of financing and whatnot. And so different tokens will succeed. The number is much lower than we have today.
Yeah, you're never going to go wrong in following the messaging of where things are headed in financial markets associated with BlackRock, right? So they've got their BUIDL portfolio that's grown from 500 million sort of at the outset to 3.5 billion now, let's call it over the last 4.5, 6 months. That's not because those assets have dramatically increased in price. It's because their customers are shoveling money into that portfolio. It's funny, Dave, this, we hosted a bunch of people in our Arch Public Lounge. One of them, Jack Mahler's at the Bitcoin conference. and he made a statement that I think is the statement of all statements at the Bitcoin conference, and that was Larry Fink has become the CMO of Bitcoin because he won't stop talking about it. And that's true also of the next phase and the next phase and the next phase. So it's extraordinary to be in this moment with Bitcoin and crypto overall, where you have, the rise of crypto as an asset just beyond crypto and into TradFi and all of those things. But there's going to be another wave, as Josh just mentioned. What's the next, couple of assets that rise and become part of the conversation? Well, again, BlackRock's going to be a mover in that space. Why? Because they're going to be using those tokens in some way, shape, or form in the tokenization of real world assets. That's another thing that Larry Fink kind of can't stop talking about, right? So if you're following Bitcoin and the rise of Bitcoin across traditional financial markets, and their IBIT product becoming the fastest growing ETF ever, that you probably should have followed that particular marker from BlackRock. You probably should follow the idea of the tokenization of real world assets and where that goes, and follow what it is that BlackRock has their hands in terms of those individual assets.
Yeah, I mean, BlackRock isn't going to go much further outside of Bitcoin and ETH, though. At least not anytime soon. Is my understanding. They're a gigantic company.
So is their BIDL portfolio just a waste of time? Are they just goofing off?
No, I'm not suggesting that, but in terms of ETFs and stuff like that, I mean, there's just materially different numbers between 170 billion or whatever the number they have is in the Bitcoin, or whatever that, maybe 70 billion, whatever the number they have in the Bitcoin ETF is, and some of these smaller assets. I mean, remember the market cap, a lot of a lot of altcoins is just not large enough for BlackRock to be interested, right? It's just not. I mean, you can't put $3 billion in anything outside of the top 5 by market cap, even $1 billion, you can't, right? I mean, it's just not liquid enough. So I think the question I tried to pose earlier is, well, okay, so stable coins are the future, right? And stable coins will be used for payments and other things. What does that mean for crypto? So for example, over the last 90 days, as an example, just looking, there's been 15 billion in net stablecoin issuance on Tron versus Ethereum is second with about 1.2 billion, right? And so there's a lot of issuance on Tron. So the question is, do stablecoin transactions drum up a lot of activity on networks, which increases the demand for a token because it's needed for gas? And does that drive buying activity? Do stablecoin issuers care which networks their tokens are issued on? Do people become agnostic to where where a stablecoin is actually issued? And we just get to the point where there's more and more and more and more chains being deployed, so that transactions can be increasingly small, and maybe that that stablecoin demand doesn't necessarily drive down to the chain level as well. And I think the same thing goes for RWAs or anything else. Does anyone care what chain these products are built on? I mean, I'm not saying today, but I'm saying in the future, right? And what does that mean for layer ones and layer twos, right? Okay, you attracted, Tron added 15 billion in stablecoins. You guys probably didn't even know that fact, right? I mean, about 90% of the new stablecoin issuance in the last 90 days is on Tron. Does that mean that you should buy Tron? That's kind of more of the question I was alluding to.
Well, I think you're right, but I think that again points to utility. Tron is a regional utility. That's not. I don't know a lot of people that are using that functionality here in the United States, but I know a ton of people that are using it abroad. And so it's kind of like, what do you use that's the best tool that you have access to that's solving a material problem in your life? It's not as large of a problem here. The only thing that I keep coming back to, and I'd love to hear you guys' opinion about it, is how do you regulate stable coins against cannibalizing the power of the dollar? Shouldn't all stable coins essentially be backed by USD? Shouldn't there be clear correlation between what you hold as a base currency against the stable coins that you print? Like, what do you guys think about that? How do you see that?
Well, I mean, the Genius Act is exceedingly clear, right? And it's distinct from the MiCA version of the regulation in Europe. So the dollar stable coins will be backed by short-term treasuries, basically. They could, I suppose. I think they're allowed to use bank deposits, but after the one point about stablecoins that I love to make, and it makes everyone who, any one of the bank lobby people, the American Bankers Association, gives them dyspepsia because they have to understand that it's true. The only material depeg that we've seen in USDC happened because they had made them stupid mistake of putting 30% of their funds in a bank. And Silicon Valley Bank had to be propped up, and FDIC didn't cover most of it. So if it wasn't for a bailout, then it could have depegged. And so what's important is that the Genius Act effectively says the only thing that is a stablecoin is something that is fully backed by short-term, basically U.S. government paper or insured paper. That's it. And so there is no risk about that. What does this mean? This means that anything else that calls themselves a stablecoin, whether it's algorithmic or backed by something else, isn't in the United States.
I did not know that. I appreciate you clarifying that. That's a huge distinction for me. And I do
what's
think
important, just let me complete to show you just how dumb the Europeans are, and it's mind-boggling how stupid they are sometimes. Is in the MiCA rules, it actually says, I think it's 40%, but a very large double-digit percentage of all backing for stablecoins that are euro-backed stablecoins have to be in banks. So effectively, you take a system that would be fully backed, de-risked, and you make it risky by trusting the banking system in a world where people will charge money for risk, meaning that their stablecoins are going to Europe stablecoins that are authorized under MiCA are going to trade below parity. That's just the way 100%. It is. Whereas Tether probably won't be legal as a stablecoin, but they're just move out, and people Tether right now, and it has traded at a premium for a very long time whenever markets do well. And the reason, just so you know, the reason for minting stablecoins right now, the use case for stablecoins, by far the biggest use case, is to buy crypto. It's a gateway, right? Mm-hmm. People buy Tether in order to buy crypto. There are lots of countries around the world where you could go into your bank, you could deposit whatever your local currency is, and you could come out the other side with USDT and then use that to buy crypto. So that effectively promotes the dollar internationally, which is why that USDT isn't that, plus Howard Lutnick's company is one of the backers. I mean, Howard, it was at Cantor Fitzgerald. His son is running it now. It's one of the reasons why Tether will likely not be excluded from U.S. stablecoins, or at least be able to participate, because it is a huge buyer of treasuries, bigger than, I think, 13, all but 13 countries or 12 countries. And but it's the gateway to buying crypto. Now, stablecoins are going to expand way beyond this as the gateway to buying crypto. It will be the gateway to all payments and all buying, but that's going to take time.
Yeah, we're going to shift. Thanks, Josh and Dave, for being with us today. We appreciate all the commentary. We're going to shift to a little bit of arch public discussion, but thanks for your time today, and have a wonderful, wonderful Tuesday. Thanks, guys. Much appreciated.
See you guys.
Thanks, guys.
So taking a look at, Arch Public Algos, we, everybody knows or should know at this point that our algos are free for use. So if you're going to be involved in what we do and how we do it, and you want to dip your toe in and take a look at how our algorithms work, your ability to make adjustments and twist some levers and turn them into what you want them to do, it's all free. It's all free for you to use. Something that I wanted to highlight, in this past 7 days, we had this big, Musk Trump dust up, and it turned into the volatility that offered opportunity for people in space to grab assets that they like cheaper. But were you able to do that? Were you able to do that at the bottom of that particular feud? And where do we stand today? And so taking a look at what our algorithms just did on their own in the midst of that, you bought Bitcoin at 101, right? We're sitting at 109 and change as we talk here today. You bought XRP at $2.09. We're at $2.29 right now. You bought Solana at 145, and if I'm looking at it correctly, we're at 159. Earlier today, we were at 160 and change. So you're looking at 8%, 6%. And nearly 12+% on Solana in just a few days associated with those purchases. Again, Tillman, talk about the ability that humans do or do not have to make those decisions when Bitcoin is moving closer and closer to going under 100. In fact, I think we were on this show last week or on a show like it, and Bitcoin was moving in that 100 space. And I think Dave said, I wouldn't be surprised if we wake up in the morning and we're in the 90s. We never got there, right? So even the tried and true, been around for a long time, crusty trader guy is thinking that it's going underneath 100K, and it didn't, right? So algorithms are smarter than all of us, and so
well, it's not about intelligence, right? The markets are there to prove you wrong. They don't care about what your opinion is. All they do is move to the liquidity. So if the liquidity is below the price, they're going to most likely move to that pocket of liquidity. If the liquidity is above the price, the market maker is going to move it to that pocket of liquidity. And if you're not trained in looking at the depth of liquidity in a market, you're not able to make decisions based upon liquidity. And so algorithms, again, aid you in the ability to do a lot of complicated math behind the scenes without you having to do any of it, and then execute based upon that math. And so it's more about discipline, and it's more about not trying to time the market. I think Dave and every professional trader out there will tell you that the first realization that they had on their way to being a successful trader is realizing that they can't time the market, and that they have to have systematic approaches that are based upon risk reward ratios and probability. And the probability is a guess, and you're doing your best to try to, read the tea leaves, so to speak. But that is short-term trading. The interesting thing about algos is it's not focused on trading for profit. What it's focused on is getting you great cost entry points. So when you're looking at Bitcoin and you have these massive dips in a 1-day period or a 4-hour period, you should be asking yourself, is this a time to buy? Not, is this a time to panic sell with the rest of the sellers? And so algorithms keep a very disciplined approach and don't let you make bad decisions based upon the emotion that's in the moment. And so when you see an Elon Musk Twitter feud with Trump and the price of Bitcoin falls, think about it. How does that have anything? What does that have to do with Bitcoin? How is that going to impact Bitcoin's adoption curve? It's not. In fact, every other sign that you could read, every other headline is going, Bitcoin is being adopted at an increased pace with every day that goes on. That would be the logical way to look at the markets and go, there's an irrational, emotional driven response. I'm going to take advantage of that. And if you do that over time, and if you, for example, most of our customers keep a pretty bull bias ratio of buy to sell in their strategy. And so, if you did that, you didn't sell 100% of what you bought at 101 at 107. If you had a 2-to-1, you sold 50%. So you bought at 101 because it was an exhausted candle that allowed you an opportunity to buy a dip, to buy your favorite commodity asset on sale. And then when the volatility presented upside, you took some off the table so you had more cash to reinvest back into Bitcoin. It's very, very simple, guys. It's not a genie in a bottle that's printing imaginary cash out of thin air. It's really about just taking advantage of the volatility that presents itself in Bitcoin every single day. That's why we love it. Because if you know how to play the volatility, you don't have to wait for 100% price increase. You can grab 10% price increases. And that means you can grab 10 5% swings like we just had. We had a 5% swing to the downside, and then we had a 5% return up to the upside. That's a 10% movement if you know how to take advantage of it. You stack 10 of those together, and it's as if you doubled your stack. And so taking advantage of that volatility, I think, is impossible for manual traders. I think it's highly emotional, highly stressful, and you have to be sitting in front of your computer 24/7.
Yeah, no, it's not easy. I mean, again, to the point that I made, Dave is as sharp as they get, and it's his thought process. Well, we'll probably see a little bit of a dip down in the 90s, and all of us kind of shook our head. Yeah, that makes sense. And again, it didn't happen. And so, associated with programmatic decision making, and I've said this so many times over the last 6 months. There used to be, 5,000 people on the floor of New York Stock Exchange making emotional decisions based on price movements. Those people no longer exist. Those people are not on the floor anymore because programmatic algorithmic trading dominates traditional finance, absolutely dominates it. And at some point, that's coming to crypto. Just so happens that Arch Public is a first mover in the space, and you have the opportunity to use that programmatic capability for free. You go to archpublic.com, you sign up for our free version, and you see for yourself how it works. And you're kind of blown away. You wake up at 2:30 in the morning and like, oh wait, took a trade for me, and it did what I physically cannot do because I can't stay awake for 7 days in a row.
Well, and it solves a lot of the traditional issues with trading automation, which is you have to give your custody of your funds over to people. We do not custody funds. We do not make trades for you. We do not aid and assist you in making trades. We have software that will be the most powerful tool you've ever used to help you in your trading journey. And seeing is believing it. That's why we've made it free. If you sign up, we will spend hours on the phone with you getting you set up and make sure you know how to use the tool. You'll have first-in-class customer service. We've been in the space for long enough to know that that's a huge deficiency, and we're here to try to do our best to remedy it on our little front. So yeah, reach out to us. We'd love to have a conversation, love to get you set up, love to get you trading and using the tool at absolutely no cost, so you can kind of see why we're so passionate about the future and what this means for retail investors. It's really something that only institutions have had access to, and they've had access to it for decades. And it's part of what Dave said earlier about proprietary systems and software that don't speak well with one another. If a trading firm created an algo, it was created for their specific internal software, and it was very, very customized for that application, and it's not commercially available to everyone else. Those days are changing, and we're pleased to be on the front end of it. And one of the reasons why we like Dave so much is that he speaks our language. He understands this. He's been using automation for a decade plus, knows exactly what the benefits are, and it's fun to talk about all the benefits because it's a new age in trading for retail.
Can I make a point how even for me, how fun it is to see an alert in my email that you bought, Bitcoin alert, buying at 101. Actually, one of the models actually had it sell at above 110, on a lighten up strategy, which since we're now $1,000 below that, that's pretty good.
Yeah.
People need to understand that it's like I always joked. I think I told you guys this joke. I was at a conference once and we were describing algorithms. This is back in the old days before people ever used algos to trade, or it was still whatever. And I said, imagine if you were on an airplane and the captain, goes over the loudspeaker and says, hello, ladies and gentlemen, my name is Captain Smith, and I don't believe in advanced avionics because I know how to fly an airplane and I don't trust these computers. So sit back, relax, and know that you're in good hands with 40 years of flight experience. And I joke, how many people get up and leave the plane because of terror? We rely upon avionics to keep us safe in the air. Well, the truth is advanced, algorithmic trading is exactly what institutions now use for doing all their trading. I mentioned earlier in the show, Michael Saylor does it. Mm-hmm. So why, as an individual, would you want to be pushing the buttons yourself and making these determinations? It doesn't make sense. Instruct a machine to do it. That's the simple answer. That's why.
And I think you combine these technologies, and you had pointed out what you were involved in earlier, and I'll give you a plug here because I think it's incredibly important. But every single builder in the space is trying to accomplish solving a problem, right? Making it easier to scale into, a treasury, essentially a BTC treasury. And so, when you're talking about software and how it can help, Dave has got software that they've developed that allows you to put one order in and it will route it to the deepest liquidity pool across multiple exchanges. Well, we're incredibly at Arch Public fascinated with combining that technology with our technology for institutional treasury strategy purposes. But the point is that the market is changing because access to these types of tech stacks are now getting integrated at a platform level, at an exchange level. The exchanges have figured out that these tools are the most valuable tools to aid and assist their customers in making informed decisions and having informed strategies that are executing on their behalf. And it's just a really exciting time to be in the market. And I don't think we would be getting the recognition and the customers that we are if we didn't have the regulatory headwinds going in our favor and we didn't have the crypto markets really pushing this innovation, because it's this overarching theme of it's time for retail to have a level playing field, right? It's time for retail to have the same access to the same financial markets, to the same tools, to the same accredited investor opportunities that used to be, an invite-only club.
Yeah.
And now you're seeing this kind of really take full and front and center stage because of the Bitcoin Treasury attraction and what it means to the overarching economy. So it's exciting times. Really, really pumped about being a part of it and getting to talk with smart guys like Dave. It's really a lot of fun. Andrew, did we lose you?
No, I'm back. Just somebody pounded on my door. So that is it for today. Go to archpublic.com and use our software for free. Thanks, Dave, for taking the time. Really robust discussion with Josh and Dave and Tillman. And Dave, at some point, you're going to have to shave your head and grow a beard to fit in. And we'll see you later. Have a fantastic day.
See you guys.
You bet.
Let's go.